everybody, again with foreign currency transactions. In this video, we will continue the discussion of learning objective number 4 and number 5. We will start to discuss the context in which company may be exposed to foreign currency exchange risk, and we will move to understand the characteristics of derivatives and the common types used to hedge foreign currency exchange rate risk. Now the question is, okay, we have entered into foreign currency transaction. As we discussed before, foreign currency transactions means that we entered into transactions that denominated and will be settled in a currency rather than the reporting currency. The reporting currency is, or the functional currency is, the currency that we use to report or to record our transaction. Now, as we have imported transaction or exported transaction, we have a transaction denominated by foreign currency. Let us see an example to clarify this idea. Right now we are located in Palestine and we prepare our financial statement by Jordanian dinar. So the Jordanian dinar is the functional currency that we use to prepare our financial statement. Now we have imported goods from Turkey, for example, and the goods denominated by the US dollar, and we have to settle this amount that we owe on the date of settlement by the US dollar. So in this case, this transaction is foreign currency transaction. The question is, as we entered into foreign currency transaction, may we expose to exchange rate risk because of the fluctuation of exchange rate? Here in this point, the question is, how can we minimize the risk of fluctuation in the exchange rate? As a decision maker, one of your rule is minimizing the risk. So this is what we are going to discuss, how we will minimize the exposure risk of exchange rate risk. So first of all, let us see the situation of currency or foreign currency exchange risk. First one that we have discussed already a minute ago, an actual existing foreign currency transaction that result in the recognition of assets or liability. As we have foreign currency transaction, we exposed to exchange rate risk. Also, may we have a firm commitment to enter into foreign currency transaction, or we forecasted the transaction in the future. We expected that may we settle amount in foreign currency, or may we receive amount in foreign currency. Or fourth alternative, we have investment in subsidiary company by foreign currency. So the question is, how can we minimize this risk? How can we minimize the exposure exchange rate risk? To do that, we can enter into forward contract or future contract or swap contract or option contract. It means that may we enter or we entered into or we acquire derivatives or financial derivatives to protect ourselves against the fluctuation. This is the most important point, against the fluctuation of exchange rate risk that we have discussed in learning objective 4. We can protect ourselves by derivatives, by entering into forward contract or future contract, option, or whatever, or what's the most appropriate financial instrument that we can enter or acquire, depends on our situation. As we discussed before in the previous videos, may we enter into foreign currency contract or foreign currency forward contract or foreign currency future contract, and we have discussed the difference between both of them. Also, we can enter into foreign currency option. Now the point is, we have two options to protect ourselves. We have fair value hedge and we have cash flow hedge. As we have transaction or as we have recognized foreign currency transaction or recognize foreign currency denominated assets or liability. In this case, we are talking about fair value hedge. We are entered into forward or future contract to protect ourselves against recognized foreign currency transaction. If we entered into forward contract or future contract to protect ourselves against forecasted foreign currency transaction or forecasted functional currency, in this case we are talking about cash flow hedge. And the main difference between them, as we have fair value hedge, so we are talking about recognized transaction, so we will recognize the difference of gain or the amount of gain or loss in the net income. Otherwise, if we are talking about forecasted transaction or cash flow hedge, in this case we will categorize the amount of gain or loss as other comprehensive income. In the coming videos, we will move to discuss the accounting treatment given various types of foreign currency hedge. Let us move to the coming video. See you there.